Hi everybody, it's been a long time no see here. As always, I keep saying it, I keep forgetting about YouTube. But that's fine because today I really wanted to share something that I had to pay again a lot of attention to in January because apparently January is not one of the best months for trading either. And for me, in 3 years that I have been trading, it's been the most difficult January among all of those 3 years. So there have definitely been things that I've learned again that I had to look through, that I had to pay even more attention to. So I just want to share. And overall, the context of this video are gonna be the time frames, how to use them properly, or just like a reminder maybe for some traders, your patience and the stop losses, take profits, how to better place them, and so you're not getting stopped out or placing reasonable take profits so it hits and not the maximalist take profit, because admit that you have been there too, placing huge take profits and then wondering why it's not hitting. So I'm gonna cover these things because this month I had to be reminded of those things again, and I just want to remind you guys too, just in case maybe someone forgot. First things, the patience. I'm not gonna be talking too much about specifically patience because I feel like this thing I've already talked about it a lot of times, but I feel like specifically patience remains one of the biggest and the most common problems for especially beginner traders, people who have been in trading for a bit more extended amount of time. It sometimes still happens to be a problem, and for me this month I have faced this problem. And for me this month I have faced this problem again, so I just want to quickly discuss about it. First thing first, we're not rushing into placing trades, okay? For any new people in trading, never rush into placing trades just because you see the price moving, the candlestick moves sharply up or sharply down. Usually when the price moves sharply, that's usually a manipulation. Or sometimes it's liquidity sweep. So either manipulation or liquidity sweep, but like manipulation is kind of like, can be liquidity sweep too, okay? So never ever rush into trade just because the price has moved fast. For me, it was pretty hurtful. Let's say I was planning to make like a setup, right? But I didn't really see all of the confluences, like all of them that I usually should have. But the price still goes the right way, and I start feeling bad. Like, oh, I could have taken this trade. And there we go again. We could have, should have, would have, etc., right? These are the biggest enemies. Could have, should have, would have are the biggest enemies for traders. Why? Because then you feel bad and you're like, oh, I'm missing out. The worst thing you can do in trading is to feel like you're missing out because you never do. The charts are always open, especially the crypto market. For us crypto traders, me including, the 24/7 opportunity to make money is open. Don't be sad, okay? The money is not escaping from you anywhere, okay? But by you rushing into trades, you're gonna keep donating the money to the market, and I bet you don't want to do that, right? So make sure, again, and if you're a beginner, make sure that you're always with irrational thinking. You're always thinking rationally, and you are keeping the cool mind when you are analyzing the market. Don't analyze the market based off the single candlestick that you're seeing they're just sharply moving up or down. That doesn't mean anything. Look at the history of the candlesticks. Look at the history of the movement, the general direction of the market, how the price is behaving on different time frames, right? Depending on the kind of trading you're doing. For swing traders, for people who are trading for a bit longer, on higher time frames like me, we're looking at daily, 4 hour, 1 hour time frames. If you're a swing trader, I'm begging you, do not analyze charts on 15-minute time frames, because the structure there shifts more than even an hourly time frame, and you don't want to be placing trades on 15-minute time frames if you're a swing trader. Yes, some traders are saying you can use 15 minutes for finding confluences for better like sniping entries. I say don't use it. I use specifically daily, 4 hour and 1 hour. These are the best time frames for me for bigger probability And if you are using lower time frames to get a sniper entry, but also keep in mind that smaller time frame changes structure a lot more often. And what that means is that the structure it has is an internal structure of the market. And the external, which is the main structure, is still in higher time frame. So if you're a swing trader, don't go to 15-minute, 10-minute, 5-minute, 1 minute. Don't do this harm to yourself because you're gonna be losing trades, I guarantee you. That's what I did twice in 1 month. The same mistake. I did place my stop loss based on a 15-minute time frame, which I should have not done. Okay, so, and speaking of take profits and stop losses, which is also not less important topic, is we have to be able to place a reasonable stop losses and take profits too. Not only stop loss should be reasonable. Because, firstly, speaking of stop losses, again, if you're a swing trader, don't use 15-minute to place your stop loss, the initial one where you're just placing your trade. Why, you may ask? Because again, the lower time frame is, the more changes it has in the market structure, right? It shifts from uptrend to downtrend a lot more often. This is internal structure. The price fluctuates. That's normal. But if you're a swing trader, you only pay attention to the price action on higher time frames because they hold a lot more meaning and they are a lot better for you to use because for whatever reason, you're a swing trader. Okay, so don't use small time frames because they're not gonna do any good for you. And if you place a stop loss based on the 15-minute time frame, you're probably not gonna be placing your stop loss based off the major structure, which is on the higher time frames. You're gonna place it based off the internal structure. Yeah, we all know we have to minimize the risk, yes. But at the first place, make sure you're reasonable. Because the price, let's say if you're in a short position, let's look at this example, right? That was my trade, right? That was pretty hurtful. The price went my way, but I got stopped out. And the reason here is you can see clearly that my stop loss was above the high, right? Like you said, like, well, it's above the high. Yeah, but the high in 15-minute time frame, right? And I'm a swing trader again. And look where was the strongest high, the protected high, where I should have placed my initial stop loss. Is this one on 1 hour, right? And if I did place it there, I would not be stopped out and I would hit my take profit, right? So I hope this example is pretty clear for you and it gives you a good reason to use higher time frames if you're a swing trader. For any day traders or scalpers, okay, the same thing applies for you. Let's say if you are a day trader, you're using, let's say you can check a daily bias on daily time frame, but then let's say you use 1 hour time frame, 15-minute time frame, or like 5-minute time frame. If you base your entry based off the 15-minute time frame, for example, do not place your stop loss based off the 1-minute time frame, because this structure may shift a lot more often than the 15-minute one. Okay, so it applies to all kinds of trading, swing trading, day trading, scalping, anything, okay? Do not use crazy smaller time frames for placing your stop losses if you use slightly higher time frame. Obviously, the same thing applies to take profits because yes, we all want to take our profits. We want the profits to be bigger, but don't be greedy, okay? Make sure that not only is your stop loss is reasonable, but also your take profit. Leave your greed alone. And also, we're gonna talk about the greed here too, because for me, now thank God it's not a problem, but it used to be one of the biggest problems. Like I always say, firstly, you calculate your loss and not the profit, okay? The profit is great, but also remember about the loss because it can happen to you anytime. And if you only calculate and get excited about the profit and you forget about the loss, only expecting to win that trade, I guarantee you, it always works like that. You're gonna lose that damn trade. And you're gonna be lucky if you don't. That always has been happening to me only like that. Okay, so make sure that both are reasonable. Okay? And again, back to the take profit. base your take profit on the key areas. And what are these key areas? These can be liquidity pools. These are different names for pretty much similar things. This can be liquidity pool. This can be support and resistance zones. For me, for the person who uses support and resistance as a part of my strategy, I place my take profit based on support and resistance levels. So on one of these levels, depending if I'm in a short or a long position. Or if I see that these areas are kind of very far from where my entry was, so I'm assuming, well, maybe the price is not gonna leap all the way there. So I look for the nearest liquidity pools. Let's say if I place a long position, for example here, I place a long position and we see that on the left side there is a high that was previously made. So I may target this high because there is a resting liquidity. So primarily, you can call them whatever, but in general, meaning these are all liquidity pools. Okay? And you should place your take profit there because very much so likely the price can reverse from these areas. And liquidity pools are always areas of interest for the price to go to because it collects these orders, it stops traders out. Okay? And it collects more capital. That's why the liquidity pool is always a magnet for the price and the price is always drawn to these pools. And I'll make a separate video on how to trade with using liquidity pools because basically if you are trading off of a liquidity pool, right, after the liquidity has been swept, you're having a bigger probability of your trade playing out and you making a good prediction for where the price is gonna go because the price usually reverses from where it has swept the liquidity from, okay? So I'm gonna make a separate video on that, how to use liquidity pools, how to trade reversals, because that's one of my most favorite things in trading, and I think that's one of the most understandable, not gonna say easiest, but one of the most understandable concepts that you can ever grasp on. So stay tuned, that's all for this video. I just wanted to share some things that I had to, again, remind myself of this month, and hopefully it was helpful for anybody, for beginners, for anyone who has been in trading for some time already. And yeah, I'm gonna see you guys in my other video. I will try my best to be more consistent here on YouTube because, you know, I cannot just leave people here just like canning like that, right? I feel kind of bad. But thank you for watching and see you guys in my other video.